Well, not exactly smooth sailing for the equity markets for the past few months, with the Dow falling about 8% since April. Let's check in with Mike Seery of OlympusFutures.com, joining us from the CME in Chicago. Good morning. Thanks for being here.
Good morning.
Just your take, first of all. We're at the beginning of second quarter earnings season. What are you expecting on the floor? I mean, is the broad expectation here for companies to really put out results as they did in the first quarter that impressed investors pretty much across the board?
I would think so, and we've already had a 6-day rally, so they're expecting decent earnings. Alcoa came out with decent earnings, but they are expecting good earnings. If the earnings turn weaker or negative, then look out on the downside on this market. But right now, they're expecting good things.
I think below the surface, though, the question is, Mike, are those strong earnings because of cost cutting, because of very tight belts of these companies, or are these real, strong, robust earnings regardless of that?
Well, I think it's a combination of both, but I think more it's the cost cutting and the fact that they don't have the excess labor costs because they've been laying off. Look at Merck earlier this week.
Sure.
Laid off 15% of its workforce, saved almost $4 billion. Well, that's going to look great on the bottom line, but that's not going to help the economy in the long run. We want Merck to be hiring, not letting go to increase their earnings.
It's interesting, though, when those strong numbers come out, and even if they are a result of massive cuts within a company or a massive belt tightening at least, the market reacts positively. So the question is, you cannot continue to cut dramatically. You have to stop that and show robust results without cutting and then hiring on top of that. So I wonder why the positive market response that you're expecting.
Well, that's just what always seems to happen. When a company lays off workers, you're saving $4 billion. That's a lot of money, so the stock is going to go higher. But that's very, very short-term thinking. Long-term, that's still negative for the United States. We need unemployment to get back down to 8, 7.5, something sustainable. This 10% is, for too long a period of time, eventually is going to cause weakness once again.
Looking at other factors affecting the market, Europe's economy, the broad spectrum of that, a downgrade of Portugal's debt coming today. What kind of impact do you think that will have? Because just 2 months ago, we saw a massive impact on U.S. equities because of what was happening in Europe.
The news has kind of gotten old. You're right. If that had happened 2 months ago, the S&Ps would be plunging right now. S&Ps are higher again for the 6th day. It's gotten old. You need a new shoe to drop, a new country or a new crisis, but that's just gotten old. You can only beat a dead horse for so long. The news just gets old, and that's what's happened. No one's paying attention to that Portugal downgrade today.
No,
they're all focused on earnings.
Very interesting that they're not, and they were so much not long ago at the overall debt crisis in Europe. What about a lack of confidence among investors? What's the concern there for the impact on the equities market over the next quarter?
Well, I think there is a lack of confidence. I think there's a lack of confidence in President Obama. There's certainly a lack of confidence in the Congress. And I think people look at the Obama administration as being negative towards business growth. I'm not sure if that's true or not, but there is a perception out there of that. You just need unemployment to go down, and I think everything will heal itself. But how do you get unemployment down? You need growth from the private sector. And I think the government's got to get out of the mess some of this. I mean, all we're doing is adding government jobs. The government's getting so large. I think that's going to be a problem eventually.
Speak to that more specifically, if you can, Mike, your sense there on the floor that there is this anti-business sentiment coming from the Obama administration. Can you speak specifically to the comments you hear from your fellow traders and especially your investors?
Well, the comments that I hear is just too big a government. Government's involved in everything. They want the government to be the government and get out of the markets and quit putting your feet and hands into this market. Too much intervention, and that's the problem. The markets just want to be the markets. Now, whenever the S&P is up, oil's up, gold's up, they're all one market. In the old days, you could have the S&Ps down and gold and oil up. You don't anymore because all it is signs of government strength or government weakness. But eventually, the government's going to have to get out, and that's what people are nervous about. What will happen when we do get out? See, that's the problem. We've never had that problem before because the government has never meddled into our business so much, but this time they have, and we don't know what the end results will be.